I want to underscore this point. If cash flows stop getting to bondholders for even a short period of time, often measured in single-digit days beyond the prescribed monthly payment date, you have what in fixed income rated bond world is a catastrophic event, meaning a default, capital D default on those bonds. Bondholders did not get paid the amount they were due when they were due, which is thankfully very rare. But, in order to make that even more rare, it is very common, if not, in almost every transaction, there are exceptions, to have a backup servicer in place so that the cash continues to flow to investors, to who it ought to flow to on as prescribed by day one. So I wanted to make sure that was crystal clear in people's minds before we move too far ahead in our discussion. I'm going to pause here. Is there anything I missed in terms of the role of maybe servicing and backup servicing, but also any other roles that you want to develop here that Vervent takes on while we have the, setting the...
Yeah, it's the selection of the backup servicer is equally important because you want to engage a backup servicer who can actually do the lifting if this happens. There are some backup servicers who don't have a primary servicing operation, and then they try to place the servicing when there is a trigger. The problem is a lot of times these assets are in distress and they're not all that attractive for somebody to willingly take on. So you really want to have somebody who's contractually obligated to take it on, who's been collecting the backup servicing fees and will take over and kind of ride the transaction through. So I wanted to point that out.
All of what you were describing in your sort of overview of what happens when things don't go well or what needs to be upheld and maintained really starts with the right selection of your backup servicer because there's a partnership there early. So when you engage with Vervent as a backup servicer, there's work being done early that involves really looking at the originators or the issuers reporting, formatting, mapping, understanding the business, really going into pretty deep details, including really a know your customer process as well, which is also very important. But that all of those steps are really all geared towards the protection of the portfolio so that if we are directed to enhance our readiness in preparation of a servicing transfer event, we're much further along in the process, which speaks also to Lou's point, where if you've got that partnership in place and you have maintained an open communication with the lender or the investor and the trustee, that when there are signs of distress showing, that there's open dialogue and conversation between that party and Vervent to say, we're seeing signs. Could be liquidity, could be poor management, it's generally in our recent experience not been around the collateral itself, but other situations where we can move very quickly because we have the success and the history of actually doing conversions and boarding those portfolios.
Yeah. To that point, in the last 18 months, we've actually successfully converted 3 programs, and we're in the process of moving 2 as we speak. And each one had its own wrinkle and required its own handling. In the most part, though, to Julie's point, it wasn't the collateral. It was actually not even liquidity. It was poor management or an element of fraud at these underwriters and issuers.